So I'm delighted to invite onto our stage, starting with Martine at Kerschenmeyer. Martine, welcome. How are you doing today, Martine?
Very well, thank you.
Have you enjoyed the day so far?
Absolutely.
Wonderful. Martine has been with Advent since 2021, supporting the fundraising and investor relations activities here in Europe. Previously, he's done several other roles here in Luxembourg, including being in charge of business development at BlackRock. Also, Benjamin, hi.
Hi.
Benjamin, where are you from, actually?
France.
From France?
From France.
Where in France?
From south of France.
From the south of France?
Yes.
What are you doing here? The weather's dreadful.
I'm wondering.
And Benjamin, you're a principal at Sofina, and you've been a regular investor yourself, haven't you?
Yes.
Can you give me one example of one thing you've invested into?
I've invested in a company called Vinted. It's a secondary marketplace for fashion items. I think it's well known in Europe.
And how's your investment going?
Well, pretty well.
This
one is going pretty well.
Thank you, Benjamin. We need to send Benjamin's mic up a little bit, please. Alexander, hi.
Hey.
Alexander, now tell us, where are you from?
From France.
Also from France.
Well.
Where in France are you from, Alexander?
It's closer to here, Besançon.
Besançon.
Yeah.
Monsieur Fallin. Now, you are a partner in Unigestion.
Yeah.
You've got more than 17 billion under management. What is actually within your scope?
It's private equity diversified, so I'm investment solution member, so portfolio manager of the private equity bucket.
Fantastic. Thank you for joining us. And finally, on my far left-hand side, Sam Boughton. Sam, hi.
Hello.
Sam, you've got those dulcet English accent tones. Where are you from, Sam?
I do. I'm from the UK, but I now live in Germany, in Berlin, for 5 years.
Sam is leading the Moonfare client-facing teams across EMEA. So on a day-to-day basis, Sam, what are you actually looking after, really?
I'm looking after a client-facing team. My team is about 14 people, and they're speaking to our investors, whether they be private clients, institutions, family offices, all day, every day about private markets.
There's been a lot of buzz about Moonfare.
Good.
Does the reality back up the buzz?
I would like to think so. I mean, we're growing really, really well. It's been amazing to hear so many speakers today talking about retailization, and it's, I've been tallying up the number of times that I've heard it in the conversation. So we feel like we're onto something. We feel like we're on a bit of a secular trend. So yeah, so far, so good.
Ladies and gentlemen, can I have a round of applause, please, for our panel, How to Build and Nurture Investor Confidence. Martine, over to you.
Actually,
Oh, sorry, my friend.
It's okay. Thanks for attending this panel. So as you can see, we have a very diversified panel from the larger end of the market, larger buyout end. We have a VC growth investor, and also an investor that is Moonfare, everyone knows, are very diversified for qualified individual investors, if I may say. So let's start with Martine, maybe on the global state of investor confidence in the market in the context of private equity, first, the overall market, but also in the context of your segment of private equity, the larger end of the market.
Sure. I'll start with sort of like generally saying what's happening over the last 2 years. And earlier the question, Jim went around the room saying, what's marking 2024? Someone said difficulties in fundraising. So I would say the last 2 years really have shown a shift in the market. 2022 was probably the busiest years when it comes to GPs coming to market. It's been never seen before, the number that were in the market at the same time. You combine that with a year where investors actually were capital constrained due to the denominator effect. You add to that geopolitical challenges that we've seen starting in 2022 and moving on. It's become really challenging. So, investors remain committed to the asset class, but there's been definitely bifurcation in the market. You see managers at every end of the scale, by the way, that are raising to their target. Everyone, apart from a few exceptions, is taking longer to get to their target, but you also see a lot of managers that are actually not getting to their target. That's not necessarily a sign that they're doing bad things, it's just that people have to be more selective, and therefore it just becomes more challenging, which then also leads, we've heard it before, and I'm sure we'll talk about it as well a bit more, the fact that GPs are looking to diversify their investor base as well.
Yeah, I think on the venture and growth side, it's similar. There is a bifurcation for sure. But I think you also need to compare, the reference point. If you compare with 2 years ago, obviously we're much lower. But if you look before COVID, like where, times were more standard, like we are around the same level. So I'm not seeing like that much disinterest for the space. Maybe for my space it's a bit different. Also, you have the growth stage that has been, very damaged. But if you look on early stage on VC, most of the funds that we've, targeted recently, they are doing pretty well.
And from our side, I mentioned the secular trends in terms of investor confidence. So I think we feel like there is a secular trend, there is a tailwind for more access to private markets, private clients, private offices, investing more in private markets. So from what we have seen, that momentum is there. But we are also not immune to the lived experience that everyone in this room, I suspect, is having in the last 18 months or so. Investor confidence has been, say, slower. We're raising between, say, $500 million and $1 billion per year from private clients. We'd like it to be closer to $1 billion, and in certain years when confidence is less, it's further away from $1 billion. So we have the same experience, and a lot of investors talking to us about DPI. We're going to talk about that in this session as well. People want to see that flywheel operating, and in the past 18 months or so, if it hasn't happened, then it makes us really earn our money from a conversation perspective with those investors.
But I guess also the size of the funds, because people have been raising larger and larger funds, and now that there's a bit less of interest, of course it's taking longer to get this fund size, but there is also less activity in the market. So are these funds at the reasonable level today versus the demand and supply? And I think that these funds are too big. That's probably why they're struggling to raise. So if you adjust to the level, the right level, not the level 2 years ago, then we would not see that issues.
Sorry.
Yeah.
I don't know. I don't think that I would say the funds are necessarily too big. It really also depends on the strategy. Because what you also see is that as the market has developed, as the market has become more institutionalized, there's more opportunities. You also see larger deals. And you have to have the capital to do those deals. So I look at it more like there is a space for everyone. There is a reason to be there for mega caps, large caps, as there is for the growth space, the venture. And investors very much have all their own strategies. Some focus on one end of the spectrum, some have a bit of a mix. And I always say diversification is key.
Very interesting. So you can see diverse opinions or point of view. And if we dig a bit deeper into the fundraising, which was one aspect of the talk, we see at Unigestion, we see fundraising that are a bit different than a few years ago. Before, fundraising was over 12 months. It was quite constant. The flows were quite constant through time. Today, we see fundraising a bit more lumpy at the beginning. So first close, we see the investors that are here and that have always been here for our funds. And then you see kind of not a desert zone, but very, very few inflows until you get portfolio visibility and a final close where possibly you have opportunistic investors that are coming for the upside from day one. Is it something that you also see in your segments?
In the VC space, I don't think it makes, let's say if you wait for the second close to get visibility on the portfolio, you need to be pretty good to be able to assess each of the companies in this portfolio. So I'm not sure that, this is not what we're seeing, at least in the funds where we invested. Most of the funds where we invested this year, they closed on a single and final close. There was just one. So I'm not sure that waiting is helping LPs. What I see though is that you have some funds, they're coming to see LPs and they say, oh, look, I'm raising in 6 months. I didn't met you before. Do you want to put 20 million in my fund? No. I need time to build trust. It takes time to develop a relationship with the LPs. And I see a lot of GPs today, they're coming and they say, oh, my fund is very large. I have a lot of people that were, LPs that are either not re-upping or with smaller commitments. I need to fill that gap. And they just come to us now and say, oh, do you want to commit? Like, I need to take time to build the trust. When we're going to invest, it's for at least 10, 12, 15 years with someone. We're not going to make the decision in 2 months. And so, yes, it takes more time to build that trust, and that's probably the reason why you have fundraising taking more time now.
From our perspective, so our model is obviously slightly different in the sense that we will fundraise for a window, so we will have a fund on our platform for, say, 3 to 4 months. But so we're somewhat, I guess, agnostic as to the specific lumpiness. But I think what we do see is investors being very wary of fundraising and their lack of deployment. We've certainly seen that in the last 18 months. If you're going to commit your capital is sat there in a bank account somewhere, you're paying a management fee, and then it's not being deployed. That is a question we're getting a lot at the moment, especially when investors have planned their portfolio. If they've been thinking about vintage diversification, if they've been planning their cash flows, and they've achieved a diversified portfolio, as Martine just mentioned, but they're not starting to see that capital coming back, and then they're being expected to commit to new opportunities when they're then tying cash up for the next foreseeable. So we do see that. We see investors being very selective. Obviously, I think one of the things that we would also say is, even at the retail space, I caution that word, actually, retail. I think we're talking more about private wealth than full retail. But in the private wealth space, I think there's no homogeneous investor. We have investors coming to this asset class for the first time, making their first commitment to private markets. And then you have investors, even via Moonfare, that have done 20 million, 25 million plus with us, and they want completely different things. They want different managers, they ask different questions. And so really, perhaps there is a lumpiness. I think there's an increased sophistication about what people are looking for and how is their cash actually being used.
So I'm not sure if you're ever going to see that on Vintage in the future, but at least on Amazon and other online platforms, the new fashion is T-shirts and caps that say DPI is the new IRR. I'm sure some of you have seen it already. So basically, for me, I think that long-term relationships are still very important. To your point, you don't start a relationship just ahead of fundraising. It's something that you do throughout, inside the period, outside the period. Actually, you want to get to know your investors as much as they want to get to know you. And so, but having said that, because of capital constraints and because of investors being more selective, also concentrating their portfolios and their relationships so they can also have more focus, they will look at DPI. They will look at the portfolio, how it's been deployed, how quickly it's been deployed. Have you been able to achieve exits? What type of exits? And in that scheme, you do see GPs also coming up with new ways of providing liquidity. We've heard it earlier, continuation vehicles. LPs also asking for co-investments, which also helps GPs potentially with their deployment. So, those are the things that I don't see the lumpiness per se either, but I think that there are things that investors are looking at.
Okay, so from your point of view, you see the history of delivering DPI more important than the portfolio visibility at current stage then? Okay.
Yeah, I agree.
Interesting.
Alex, if I may, just to jump in on the DPI point. So slightly tongue-in-cheek at Super Return this year in Berlin, those of you that were there may have seen this. We created these caps, the DPI greater than IRR, and we thought, it will be a tongue-in-cheek comment. And in the end, everyone was coming up to us asking about these caps because they're saying, look, we're having these conversations all of the time in that building. It spread like wildfire. So I have to give some credit to our marketing team for that. It was a great win for us, but truly it reflected a lot of that narrative that we were hearing at Super Return this year.
Okay. In terms of fundraising, there is also another aspect, is the size of the funds that are fundraising. We touched upon that, but if we dig deeper into the data, we see that over the first semester of 24, there were 230 billion raised globally, which is a 15% increase versus the first semester 23. So very healthy fundraising market when you look overall. But when you dig deeper, you see that 10 funds represent 50% of the overall fundraising amount. So the 50% remaining has to be shared, if I may say, by thousands of other funds. How do you see that? Probably it's Martine that is closest to the large and mega space. Is it something on the large mega cap where it's very easy today to fundraise and the other ones have a hard time?
Again, I would say there is space for everyone in the market. Every investor has a different strategy. You know, as you were saying, you focus on the venture growth space. There are other investors who prefer to build a core portfolio, maybe starting with even fund of funds, maybe having some core allocation to larger managers that are more diversified. And I think it's a bit of a misleading picture to say, oh, you know, the bulk is done by 10, and then the rest they have to kind of divide it up. Because there are some strategies where you will have managers at 500 million. They do not want to take more capital. 500 million is their sweet spot. They do not want to raise $1 billion. There are some managers that are on funds 6, 7, 8, and they still won't raise more than 2 billion because that is where their strategy sits. So coming back to, you know, you were mentioning the large cap. There are large deals out there, and, you know, there is a space for private equity there, but then there is also a space at the smaller end. And so I don't think it's the right way or the right lens to look at it. Diversification.
Yeah, I think for me, discipline is what LPs are really looking for, like discipline in generating DPI, but also in your fund size. If your fund size, if you kept, like you said, a fund size that is, I mean, not increased too much, that is in line with what the market can absorb now, you will be able, and also if you look at historical performance, these funds have performed better because they were able to pick the best assets and not able, and they didn't need to go broader. So they stick to their initial strategy. They managed to be, I mean, disciplined on the generating DPI. This is what investors want to see. And so these firms, they're oversubscribed. Even if I mean, the funds could be big, but if it's rightly sized for their strategy, it's fine. What I'm referring to big funds is the funds that have been grown by 30, 50% versus the previous fund. And they're like, oh, now we're struggling to raise. Yeah, guess what?
Mm-hmm. Yeah.
Would completely agree with what has just been said, and especially by Martine's point on that space for everyone and no single type of investor. I mean, we see investors coming to the platform and thinking, okay, I would like to look at an Advent fund, a KKR fund, a CVC fund, an EQT fund, you know, the very big names that they will have heard of, they've read about in the news, and for many people that will be their first logical step into investing in private markets. Then there'll be other people that have made 10, 15 investments, they've already invested in a lot of buyout before, and they say, well, show me something in VC, show me something in growth equity. So I think really stressing that point, no homogenous investor, space for everyone. There are different strategies for different objectives, and I think this is something that we really see every single day, and on the platform it's something that we have to bear in mind when we're looking at fund selection as well.
Okay, so space for everyone. If we go back to the investor confidence and how to build and nurture, which is the topic, it's how do you see the transparency, the increased transparency that is being requested by many investors? Is it something that is now paramount or crucial to build investor trust, or just having a very steady track record with nice DPI is enough today and people sign the sub-docs?
I mean, I can give an answer to that from our perspective. I think education is being absolutely critical, and you know that this is why I meant the caution earlier of retailization. It is clear that private markets may or should not be for absolutely everyone. You know, you have to have a certain level of sophistication, a time horizon to be looking to invest in these kind of products. But education is critical. I think it's no surprise, though, that the vast majority of our investors are coming from industries that are private equity or adjacent to, investment bankers, accountants, consultants, lawyers that understand private equity and how it works. I think in the current zeitgeist certainly is DPI, and I think when we're talking about investor confidence, one of the things that we really do feel is when investors are going to start to receive money back in their pockets, then there will be a huge kind of hockey stick rebound in investor confidence. And certainly from us, from a private client perspective, you know, it's real. Investors have done their cash flow planning, they've thought about their income, what are they going to be earning, how should they be allocating their assets. And if at the moment they're 12 to 18 months behind, probably, where they thought they'd be in their cash flow planning, it's something that does really affect their confidence. And it needs to be real for them. So I think those two things, education, but also really starting to see that the returns from private markets are real, they're being felt, and that flywheel effect is back in play.
And then the transparency on fees, for example, on all the expenses, things that we see. Is it something that is increasing today?
I mean, certainly, I think, I mean, in many ways we were speaking about compliance earlier in today's session. I mean, I think particularly when we're looking at private clients, quote unquote retail investors or professional investors, the compliance is there to protect the investor and is there to kind of guide us for what should be disclaimed, how the fees should be presented to an investor. So I think absolutely critical. I think things like not just fees, but reporting, ongoing updates. Our investors are asking us for the same things that many institutional LPs are, but also many of them are doing it for the first or the second time. And so kind of even turning up the dial on those transparency requirements.
And I think that, obviously historically the institutional investors were, at the forefront of investing into private equity, and the LPEA, so the association, International Association representing LPs, has done a huge amount of work to try and bring some transparency into the private equity market as it's been institutionalized, because we're no longer in the sort of early stages of the 80s and 90s where everything goes, and so they've certainly helped a lot to make it almost standard. So in terms of the reporting fees or general reporting, there are standard templates, and you can do your own, but investors will still ask for the LPEA template or something. So I don't think that transparency per se is an issue anymore these days. Then again, you always have to read the fine print. You rarely see a fourth quartile performance in a pitch book. So, you always take it with a pinch of salt. Have to do your due diligence and dig deep, but generally transparency is there.
I agree. Transparency is generally there, but you have to look deep sometimes. And I think valuations, for example, like every GP is conservative on its valuation. That's for sure. I think I heard the pitch 100 times. Mm-hmm. And still, when you look at the valuation of these companies across different portfolios, you see that everyone has a different way to assess these valuations. So I think transparency on this, transparency on fees is generally very clear. I mean, everyone is very clear about what they want. I think what we like in terms of transparency is discussing with the management team, not only discussing with the investor relation, but discussing with the people who actually invest the money. Because this is what we really want to know, is what they are going to do with the capital that is giving to them for many years. And this is the kind of interactions with the team that is interesting for LPs, and not just looking at presentation and webinars, just talking to the people, understanding how they see the space, the companies that they value in, the trends. This is where you build the connection and the confidence from investors.
And I think that to that point, that is also something that is much more important to, for example, family offices, often stemming out of entrepreneurs who themselves, have been in businesses and like to get involved. And even sort of on the more high net worth space, people want more of that interaction. I think you always have the challenge to try to balance, of course, people need to meet those that are making the investments, understand how they're thinking, what makes you take a decision on something, how you plan to execute things. We have to balance that with also them having enough time to go out and source and execute. So hence, investor relations are still very important in the middle.
Yeah, come on. We're not taking all of their time. They still have time to source, I'm sure. 1 hour in the agenda is... 1 hour
webinar. It's completely true. That storytelling element, I think, of both the fundraise, but also the ongoing updates is absolutely massive. And again, it's bringing to life, an investment. If you are investing in public markets, you can see it moving around every day. You're reading on the news, mark to market every day. There's huge volatility. You may not like the volatility, but it's real. You can see it moving around. And I think one of the things that we have to try and do, certainly from a Moonfare perspective, as we're talking to private clients, private offices, is tell that story, make it real. Because if they're thinking, okay, well, I'm investing now, it's going to be 10 plus 1 years. They get to year 3 and they think, okay, remind me, what is it? What is the GP doing? How are they doing against those objectives? So the storytelling element is absolutely massive for us.
You're talking about when DPI comes back, when distributions come back, then the investor confidence will bounce back big time. What does it take, aside from DPI and obvious exits, what does it take aside from that for the investor confidence to fully come back to earlier levels? I know who.
Good question. I mean, DPI certainly will help a lot, and that feel that money is being returned to investors, that they are back on track in terms of the way that they were thinking about their cash flow planning. So cannot underestimate that, and there's a reason why we keep coming back to this as we're talking about investor confidence.
I think it's a function of markets, right? So, markets also need to come back. There's chatter, they're like, good large assets, have been done, the IPOs have worked, but then again, that's the minority. A lot of others are still price takers. So I think there needs to be also a view that I think once November and all that is passed, markets are maybe less volatile in terms of the mood for coming back. So overall markets need to just stabilize.
Geopolitical risk, is it something playing, or it's something so far away that it doesn't play a role?
We find ourselves talking about it a lot. I would, in order of, I think, to Martine's point, I think DPI being one. I think interest rates and inflation and the environment in the last 18 months has been a bigger driver. And also what that does, if interest rates are high, if inflation is high, it feeds into a narrative externally. It's a tough time for private equity. It's very hard for buyout managers to make the kind of returns that we were talking about in the past. That is often a narrative. It can be true, but it's often a narrative, and there's perception then, and then what needs to happen is that dial of investor confidence turning back. So actually, interest rates are stabilized. They are closer to a new normal, maybe not back to where they were, but closer to a new normal. The environment is therefore more supportive, and the long-run outlook looks positive. We think that really helps, and it's natural, I think, especially for private clients, private offices, which are the core of our investor base. If there is so much volatility, if there is so much uncertainty, then there is a tendency to kind of think, well, I'm going to play it safe. And one of the things, prior to Moonfare, my background was in wealth management. One of the conversations that I was having with my investors then was, I understand that you want to play it safe, but actually if inflation is 2-3% and you're playing it safe, be conscious that over 10 years that is going to have a real impact on your net outcomes. And that is it's a conversation that we find ourselves having a lot. It's tough to shape the investor psychology of thinking, well, I should be playing it safe because there's so much volatility. But it really is something that's our role to help investors find that long-term optimized outcome.
Okay. And just liquidity is not only about, confidence. Like getting DPI is also about ability to deploy more money. If you want to deploy more money, you need to get back your money to be able to reinvest. So it's not just that they lost confidence, they also lost the ability to do investments. So that's what we need. It is not necessarily just confidence, because there are a lot of investors that are still very confident about the asset class, are still there. So it's not a problem that we see about confidence.
Slightly going off tangent, just side parenthesis, you were, sorry?
Final words.
Oh.
Okay.
No, then I won't go off tangent.
Time for one last comment.
No, there is one comment on looking ahead and AI. We were discussing that before. Is AI going to replace investor relation people at some point?
Absolutely not.
No?
Private equity is and will always be a people's business. You might have more efficient processes, have a lot of use for technology generally and AI, but ultimately, as you mentioned, 10 plus years, I always say it longer than most marriages, you have to have a face-to-face interaction.
Fully agree. Fully agree.
I will also agree. Paradoxically, we are a technology platform, but there is no substitute for the human conversation. There is a reason why we have a team of 15 people talking about this as humans all day, every day. So I think AI can make us more efficient, to the operational excellence point. I think it can help us with things like scraping data together for better reporting, making sure that the investor experience from a technology perspective is brilliant. But completely agree, there's no substitute for speaking to someone about investing.
Ladies and gentlemen, can I have a round of applause, please, for our panel? Thank you.
Thank you.